This is the 7th week of financial markets. I'm standing here in Woolsey Hall at Yale University. This is a hall that was built in 1901 as part of Yale's bicentennial celebration. And it's here where we have graduation and all sorts of important events that bring the whole community together. I want to talk this week about the financial infrastructure. And by that I mean both the buy side, the sell side, and in between. So what do we mean by that? The sell side are people who are in the business of selling securities. The buy side are people who are in the business of investing in securities as professionals. And in between are brokerage firms or dealers. Now, the sell side that I want to emphasize are the investment banks. Investment banks are companies that specialize in helping firms or state and local governments or even nonprofits issue securities to raise the financing they need for their operations. And they then have relationships with potential buyers of these securities, and they use their relationships and their trust with the buy-side community to place these securities. Investment banks became a unique and separate business after the Glass-Steagall Act in the United States of 1933 forced companies to choose either a commercial bank or an investment bank. And then for over a half a century, firms were either one or the other in the United States. That has changed in 1999 with another act of Congress. We used to have a whole list of major investment banks, but in the financial crisis, most of the big banks either failed or converted to a commercial bank. So now we have investment banking divisions of commercial banks. Notably, Bear Stearns was a huge investment bank that failed in 2008 and was taken over by a commercial bank, J.P. Morgan Chase. Lehman Brothers is the most celebrated failure of the whole financial crisis. Lehman Brothers was an investment bank founded in 1850 that finally collapsed in 2008. But investment banking is still a very important profession, even if the big, giant investment banks are no longer investment banks exactly. They're actually the publicists that publicize information about investments that make it possible for financing to proceed. Let's go to the buy side now. These are different careers. They're different sides of the investment enterprise. Money managers. Money managers or investment managers are people who invest other people's money as professionals. The stock market is becoming increasingly professional, or it has over the last century, because people know that they need professional help in deciding on investments. Now that financial theory has gotten as advanced as it is, it's difficult for most people to make the right calls, and so we have professionals. Professionals who manage money for others have a fiduciary duty. They are doing an important job. In our modern society, people retire, or they ideally like to retire if they can, at a relatively early age. I mean, early being 60 maybe. They can expect to live another 20 years. So, this is a challenge to investment managers to help these people actually live well for 20 years after they stop working. So it's a very important field. Finally, the in-between, the brokers and the dealers, and the exchanges are another important element that we'll talk about. The exchanges used to be more human in the sense that you had brokers that would meet on the floor of an exchange and shout at each other and make hand signals sometimes to indicate trades. But now it's become more electronic, and we have millisecond trading, and we have program trading, which is computer program trading. But I think it's still basically the same profession. The exchanges, the brokers, the dealers help get people together to make a trade. We also have an outside speaker this week, Stephen Schwartzman, the co-founder of the Blackstone Group. He co-founded it with Peter Peterson. The name of the group comes from their two last names. Schwartzman, Schwartz is black in German, so that's the black of Blackstone. Peterson, Peter is stone in Greek, and so that's the stone. Creative choice of names. It's also a very creative firm, and it's a firm that so many people admire. Don't confuse it with BlackRock. It took me years to finally figure out how to keep them apart. BlackRock is a very different firm. Blackstone manages something like 200 billion of assets under management. BlackRock is 10 times, more than 20 times bigger. It's a huge difference in terms of assets under management. But in terms of market capitalization, the two firms are fairly equal. That means the value of the firm is not explained by the assets under management. They have different strategies. So BlackRock is an interesting example of a firm that spreads very widely. It sells investments to the general public. It has a huge investor base. It doesn't charge much as in fees. Blackstone, which is our speaker's firm, is concentrated on a smaller number of investments and achieves very high returns on those investments. It's a high roller, a big-time player that is remarkable for its daring. It has done a lot of things. For example, recently, it launched a new kind of security called the REO to rental. They're going out and buying single-family homes that have been foreclosed on, repackaging them into securities and selling them to investing public. This is just an example. So I'm bringing in Schwartzman, and to me it's very interesting to hear him talk. I'm glad that he agreed to give this talk about how he thinks of the world. It relates to our sense of, are markets efficient, and is it possible to beat the market? What Schwartzman gives to me is a sense of high practical intelligence, a man who wants the information, who has a sense of what one would need to know to figure out investments. And he goes for it. It's a certain kind of business acumen that is rare, and people who have it could look forward to a career in financial management. So we can listen to him, and I think you'll find that it's a difficult field. He talks about frustrations, but I'm hoping that his talk will be an inspiration.